Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review where I talk about current events for the everyday investor and home buyer. Our topics for this week, topic number 1 from the RNZ on the 19th of June, house prices to be 20% lower in 2030s than 2021 forecast. Topic number 2 from Good Returns on the 18th of June, rising inflation adding to RBNZ's headache. And third topic for this week in review from Stuff on the 19th of June, Kāinga Ora to halt over 200 developments and sell vacant land. Fourth topic from RNZ on the 19th of June, quarter of households rely on government housing support. And last topic for this week in review from One News on the 17th of June, how long will better times for renters last? As always, the links to all of these articles are in the show notes below. So first up this week from RNZ on the 19th of June, house prices to be 20% lower in 2030s than 2021 forecast. A recent housing market forecast suggests that by the mid-2030s, New Zealand house prices will be approximately 20% lower in real terms than their 2021 peak. Now that's what I call a scary sounding headline. Caught your attention now, I'll bet. So let's take a closer look at the detail. The report released by data firm Cotality, formerly CoreLogic, shows activities increasing, but overall property values remain flat. Gareth Kiernan, chief forecaster at Infometrics, predicts that house price inflation will average 3.1% annually through to mid-2030. While nominal prices are expected to surpass their 2021 highs around 2029, inflation-adjusted values will still lag significantly. The anticipated real decline is steeper than the 14% drop during the global financial crisis, but smaller than the 38% inflation-adjusted fall in the 1970s. In contrast, the 1970s still saw nominal growth of 47% due to high inflation. Cotality's chief property economist, Calvin Davidson, noted that prices have risen just 0.5% this year and may finish the year only 2 to 3% higher. With values still around 16% below their peak, he acknowledged that a full recovery, especially when accounting for inflation, could take several more years. At a modest 2 to 3% annual growth rate, prices might not return to their previous highs for 5 to 6 years or more. Davidson explained that the current downturn is deeper and more prolonged than previous cycles, partly due to tighter lending restrictions such as debt to income and loan to value limits. He said it was always likely this recovery would take longer than the post-GFC rebound, which took about 5 years. ANZ projects monthly house price increases of 0.5% for the remainder of this year, but warns that recent economic softness could slow that pace. Westpac's chief economist Kelly Eckhold maintains a 6% growth forecast for 2025, though he noted recent data underperformed expectations and said the bank would reassess in August. Despite growing buyer activity, Davidson pointed out that high listing volumes and concerns over job security may continue to dampen the market. However, he also noted that the current lull could offer opportunities for buyers and may serve as a healthy recalibration for the market. So my thoughts on this article are, the devil's in the detail. While at first glance the headline makes it look as if values in 2030 could be 20% lower than they were in 2021, that's not at all what this article's suggesting. Nobody's expecting values to drop further than they already have. In fact, most predictions are estimating values to increase anywhere from 2% up to 6% by the end of this year. What it is suggesting, though, is that the recovery might take a little bit longer than in previous cycles. That's great news for anyone who's considering buying a property for the long term. I'm speaking to all of you home buyers and property investors. That means that we might have a stable and balanced property market for some time yet. No need to panic buy. This is the time to negotiate a great deal so you make your money when you buy, add value when you can so you can create your own capital growth, and buy based on cash flow, not capital growth. Opportunities are almost everywhere at the moment, but most people don't know how to spot them. If you don't know what I mean, maybe it's time you came to one of our free events. Go to propertyapprentice.co.nz and register now if you're interested in learning about what it takes to become a successful investor instead of just being sold a property. Topic number 2, from good returns on the 18th of June, rising inflation adding to RBNZ headache. New Zealand's inflation is expected to exceed the Reserve Bank's 3% upper limit in the upcoming quarter, raising concerns about the likelihood of further official cash rate or OCR cuts. With the RBNZ scheduled to review the OCR on July the 9th, BNZ Head of Research Stephen Topless suggested that the central bank may pause any rate reductions. His remarks follow new data from Stats New Zealand showing food prices increased by 4.4% in the year to May, driven by spikes in fresh produce, meat and energy costs. Topless noted that while the RBNZ typically overlooks short-term price shocks, its recent monetary policy statement revealed internal unease about persistent inflation. One committee member even opposed the last rate cut, signalling possible resistance to further easing in July. Global tensions, particularly the Israel-Iran conflict, also have triggered a reversal in declining oil prices, with expectations that fuel costs could continue climbing, further fueling inflation just as winter sets in. According to BNZ, the most concerning price increases are in categories that directly affect household budgets and are difficult to avoid. While falling global commodity prices may eventually ease pressure on food inflation, energy prices are rising rapidly and could offset those gains. Topless highlighted that the recent oil price changes contrast with May's fuel price declines, and pump prices are unlikely to drop unless global freight disruptions worsen. As a result, BNZ has removed previously expected declines from its inflation forecasts and now anticipates a higher CPI, the Consumer Price Index track, for the second half of 2025. Despite near-term pressures, BNZ still expects inflation to stabilise over the medium term. The bank forecasts inflation to return to the midpoint of the RBNZ's 1 to 3% target band by the third quarter of next year, driven by softening global demand, fair economic capacity and easing commodity prices. BNZ economists are waiting for the results of the July 1 quarterly survey of business opinion, the QSBO, before deciding whether to revise their interest rate forecast. If business sentiment weakens significantly, they may support another OCR cut. Still, the bank expects the cash rate to eventually fall below 3%. My thoughts on this? Must be winter. Everyone seems to be a bit down in the dumps at the moment, maybe because we've had about 3 years of recession already. So what do? Some people like to gaze into a crystal ball and make all sorts of scary predictions. This is one of the reasons I like property investing. It's a long-term investment strategy. Whatever happens in the short term doesn't matter so much as long as your plan is solid and you've bought the right type of properties to suit your financial position. But hey, while all the doom and gloom merchants are putting fear and doubt into other people's minds, that leaves abundant choices for those that look for opportunities. It's called counter-cyclical investing. Other people might think you're bonkers, but in 10 years' time, the same people are going to be asking you how you did it. Third topic for this week in review from Stuff on the 19th of June. Kāinga Ora to halt over 200 developments and sell vacant land. Kāinga Ora will stop more than 200 housing projects and sell around 36 hectares of unused land as part of a government-led overhaul aimed at restoring the agency's financial stability. After reviewing over 460 social housing developments, Kāinga Ora found that 212 either failed to meet financial standards or were located in unsuitable areas. These projects will no longer proceed. The agency also assessed its land holdings and decided to sell about 20% of its vacant land, which it deemed unnecessary for future development. Chief Executive Matt Crockett said that the land to be sold no longer served Kāinga Ora's housing or urban development goals and could be better used by other developers to help boost national housing supply. The agency expects to record one-off accounting write-downs of $190 to $220 million as a result of this reset. Crockett noted that while some asset write-downs are routine, the review revealed an unusually high number of underperforming projects and surplus land, prompting immediate action to strengthen the agency's financial footing. Housing Minister Chris Bishop introduced the turnaround plan in February, aiming to refocus Kāinga Ora on its core roles, managing social housing effectively and contributing to housing supply at or below market rates. The plan also emphasises better community engagement, property upgrades, improved operational performance, and sustainable funding practices. Starting mid-2025, Kāinga Ora is expected to deliver around 1,900 to 2,000 construction events each year, including 1,500 new builds and 400 retrofits of existing homes. Finally, a stop to wasteful spending without results. Enough said. Fourth topic for this week in review from RBNZ on the 19th of June. Quarter of households rely on government housing support. New data reveals that about a quarter of all New Zealand households rely on government assistance to cover housing costs, highlighting a growing dependence on support and prompting calls for a more coordinated housing strategy. Figures from the Ministry of Social Development and the Ministry of Housing and Urban Development show that nearly 377,200 households received the accommodation supplement, which helps with rent and mortgage payments. An additional 107,500 households get temporary additional support or special benefits, while 86,450 receive income-related rent subsidies paid to public housing landlords. Over 6,300 people live in transitional housing, and 598 households receive emergency housing grants. Given there are around 1.2 million owner-occupied homes and 566,000 renting households in New Zealand, Simplicity Chief Economist Shamabeel Yaqub pointed out that these support figures equate to 3/4 of all renters or a quarter of all households. Yaqub noted that the system's struggling to keep up, and while removing these subsidies would deepen poverty, they're not coordinated to providing lasting solutions. He argued that the financial support often drives up rents without creating more affordable housing, and emphasised the need for long-term supply-focused reform. Approximately 25,000 households receive assistance for mortgage payments via the accommodation supplement. Yaqub added that household crowding remains high, partly because housing remains unaffordable even as New Zealand's population ages, a trend that should normally reduce average household size. Child Poverty Action Group's Isaac Gunson said that the statistics highlight how fragile housing stability is, particularly for families. He described the situation as a failure of the system, where rising living costs have outpaced income growth. He noted that between June 2020 and June 2024, housing costs rose 31%, while disposable incomes grew only 24%. Gunson called for more public and community housing along with better wages, stating that temporary assistance isn't enough to fix long-term problems. Housing Minister Chris Bishop acknowledged the scale of the crisis and its financial impact both on households and the government. He pointed to the government's Going for Housing Growth strategy as a response. The accommodation supplement alone costs taxpayers around $2 billion per year. Yaqub stressed that while subsidies are necessary for immediate relief, they're ineffective in isolation. He called for a policy reset that integrates income support with a plan to grow and maintain an affordable rental housing supply, something he says is currently missing. I think it's also important to point out that Yaqub is the chief economist at Simplicity, who are developing build-to-rent projects, which will obviously add to the rental housing supply. I also think it's important to mention that, in my opinion, this country needs more landlords, not less, and it shouldn't be something that's just left to the government or big business to provide. More rental properties will mean greater choice and stability for tenants without the skyrocketing rents that we saw occurring with some of the changes that were made by the previous government. Private landlords are the cheapest rental property providers for the New Zealand taxpayer as well, just saying. Topic number 5 from One News on the 17th of June. How long will better times for renters last? Renters across New Zealand are seeing some financial relief, with average rents declining and expected to stay subdued well into 2026. According to realestate.co.nz, the national average asking rent in May dropped to $633 a week. That's $27 lower than the same time in 2024 and the lowest level since December last year. On average, renters are saving about $1,400 annually compared to last year. This slowdown in rental growth is driven by increased listings and weaker demand. In May, rental listings surged by 21.3% year on year, reaching over 7,000, marking the highest volume in nearly a decade. Wellington experienced the largest jump with an 87% increase. Contributing to the lower demand are economic pressures that have led more people to delay moving out of family homes or to relocate overseas. Meanwhile, the property sales market remains relatively stagnant, especially at the lower end, limiting transactions by investors and first home buyers alike. The rental market is expected to remain in tenants' favour for the next 12 to 18 months, according to Infometrics. Factors such as slower population growth, reduced migration, modest income gains, and a gradual economic recovery are likely to keep rent increases in check. Even with falling mortgage rates and more favourable tax treatment for landlords, rent inflation is expected to stay mild due to limited demand. Cotality also noted that the rental market's already experienced a major surge, pushing the rent-to-income ratio to record highs. With affordability stretched and fewer migrants entering the country, there's little room for further increases. Some developers are also choosing to rent out newly built homes instead of selling them, potentially because they weren't able to sell them, which adds to the rental supply. Unless there's an unexpected spike in wage growth, experts say tenants are unlikely to face significant rent hikes anytime soon. And look, what did I just tell you? It's all about supply and demand. Higher supply helps to stabilise rent increases. Also important to note that in tough economic times, people do tend to move in with other family friends or family members to help cover the cost of living. When the economy starts to get stronger and when net migration starts to increase again, because seriously, New Zealand's a beautiful country to live in with many opportunities that plenty of people from lots of other countries around the world can only dream of, the demand for rental accommodation will pick up again. It's a normal stage of the property cycle. So what are you waiting for? Join us at one of our free events called How to Succeed with Property Investing. These events are all available online, so you can gain valuable insights and strategies tailored to today's market conditions, regardless of where you live. Whether you're an experienced investor or just getting started, this free session will equip you with the key tools and insights to make confident, informed decisions. Don't miss out. Register today and take the next step towards achieving your financial success. In our free events, I'll also tell you more about how we could help you as a client to achieve your investing goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today and register. If you've already been to one of our free events and you'd like to know more about how we can help you on your journey, book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website. That's propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.